Okay, welcome everybody. It's Joe Fahmy. It is Saturday, May 24th, a little after 11 a.m. Eastern. Good morning, afternoon, evening, wherever you are in the world. I appreciate you being here. Before I start, I want to say I'm very grateful for everybody for joining. And even if you watch this later as a recording, I'm very grateful for that because one of the characteristics of successful people is their desire to improve themselves. And by being here, I have the utmost amount of respect for you right off the bat because I know you're looking to improve, whether it's your trading, investing skills, or as they say, even if you just learn one thing from any lecture or seminar, it's worth it. I hope you learn more than one thing today. But again, I appreciate you being here, especially on a long holiday weekend, taking the time to hang out with me. So I'm going to do my best to give it all I got. Go through a whole bunch of slides. The structure of this is we're going to do some slides and then show you how to build the stock screen. And then I'll take questions from everybody. And we can pretty much go until the market opens on Tuesday if you want. I'm kidding. But again, that's sort of the structure of this webinar. If you do have any questions about specific stocks or anything currently in the markets, the only favor I ask is you save it till later. So when I'm in the middle of this, don't ask me what I think about Tesla or Apple or anything like that. I don't mind that, but this is more for education to review some concepts with people. So just if you don't mind, save that stuff, specific market stuff. If I can even answer that, we'll save that until the end. So just a quick disclaimer at the bottom of this first slide. This information is strictly for informational and educational purposes. I do have to read this. Excuse me. It does not constitute an offer to sell or a solicitation of an offer to buy securities. And the stocks presented are not to be considered a recommendation, and the material does not take into account your particular investment objectives. So basically, consult your financial advisor. Past performance is not indicative of future results. Blah, blah, blah. Every disclaimer, literally, I joke about this. Every disclaimer should just say, don't be an idiot. We know the coffee's hot. You don't need to say it on the lid. We know it's hot. The whole point is, just for compliance reasons, I have to read it. Anyways, we got through that. Basically, it's for informational and educational purposes. And also, there's a promotional code for my educational product, which I'll get into later. So let's move on to, and also if you do have any questions, the only favor I ask is to do it through the Q&A on Zoom rather than the chat because it's easier for me to follow on the Q&A. Nevertheless, just a quick introduction. I've been trading close to 30 years. I manage money as a portfolio manager with a firm called Zor Capital. I also have separately an educational product on my site. And what I like to do with this is where it all came about is I used to give these in-person all-day lectures and seminars, taking people from start to finish, basically, the points there, when the market's healthy, learn to identify when the market's healthy, when it is healthy, for people who like to trade individual stocks, what type of stocks to gravitate towards, the ones that have strong fundamentals. And then from there, entry point is very important. So talking about technical patterns for entry point. And that's how the educational product came about, because rather than doing the in-person seminars, I basically recorded them and put them all on my website. And I'm going to go through a lot of these different characteristics. For example, there's 4 signs of a healthy market. I'll review one of them. There's 18 fundamental characteristics. I'll review a few of those as well. And there's 7 major technical patterns. I'll go through one of them as well, just to give you a flavor of some of the education that I do. And then I'll show you how to build a stock screen based on this information, and also take some questions from the audience. Somebody's saying, good morning, Joe. Love your IBD commentary and podcast. Look forward to your tweets. Thank you for that. I appreciate the kind comments. My only thing is keep your expectations realistic. Don't expect too much. I'm kidding. I'm going to do my best to, educate, hopefully drop some knowledge so you learn some stuff, and take some questions again towards the end. So Thank you for those kind comments. And let me just keep moving along here. Okay. I already said that when you attend a lecture, a seminar, any sort of talk, or whether it's on YouTube or you go in person, whatever, they say if you learn one thing from a lecture, then that's just, if you get one takeaway, it's worth it. If you literally don't remember anything, and this is going to go on for a while, so grab a cup of coffee or your drink of choice. If you learn one thing from this, this is one simple concept I want you to take away from, is that I go through in my educational product 4 signs of a healthy market, and there's just one basic one that can really, really help you, which is just plot the 50-day moving average. I use the NASDAQ composite. It roughly correlates with the S&P 500. I don't care which one you use. I think the NASDAQ is the go-to index because it's a sample size of over 3,000 stocks versus the S&P, which is 500, or the Dow, that's 30. But who really cares? And then another question I get is the exponential or simple? It's the same shit. Like, don't overcomplicate things. Don't feel like you need to know every single little detail to overthink things. Simple 50-day moving average. This is a simple concept. When we're above it, for the most part, the market's healthy. When we're below it, for the most part, the market's in a corrective phase or possibly a bear market, or get a little bit more defensive. And again, this is for people who maybe actively manage their portfolio or vary their investment levels. This is just a simple guide. And as I say in the slide here, that this is not an exact science, meaning it's just a general, think of it as a red light and a green light with a traffic light. When we're above the 50-day moving average, for the most part, the market's healthy. When we're below it, for the most part, it doesn't mean get out. It just means be a little bit defensive or cautious. And the reason is that the 50-day moving average is just a simple area of institutional support. It correlates to the 10-week moving average for people who are, Investors Business Daily, IBD, William O'Neill Disciples, and all that. You hear that term 10-week. The 50-day moving average roughly correlates to the 10-week on weekly charts. And that's an area of institutional support, meaning, period, end of sentence, the big institutions control the markets. Basically, your big pension funds, hedge funds, mutual funds, they control the market. So if we need to be able to interpret and follow what they're doing. If they are supporting the market with their trillions of dollars, I want to have the wind at my back and be on the right side of the institutions. If they are selling, distributing the market, reducing exposure, I want to get out of their way because they control the markets. And this is a very, very simple way of just, again, for people who hopped on late, if we are above the 50-day, the market's healthy. If we're below it, get defensive if you actively manage your portfolio. Now, this can also work on individual stocks, meaning if someone says, hey, Joe, what do you think of this stock? Or you want to take a look at this stock or ETF? I'll look at anything. I'm open-minded. I'll look at anything. But the first thing that goes through my mind is, where is the stock relative to the 50-day moving average? Is it well below the 50-day and 200-day and in a severe downtrend? Is it healthy and consistently supported by the markets, by the institutions? I feel like I have the O'Neill book somewhere here. No, I don't have it near me. I should have it near me. I'm looking for it. But in the William O'Neill book, How to Make Money in Stocks, you can go through the first 100 pages in that book because it's a great lesson on technical analysis to really, really help show you where the institution supports stocks. And it's all marked up with areas to add to stocks, to buy to stocks, where to sell, and all that good stuff. Anyways, that's just a simple concept with the 50-day moving average. Someone's asking me, and again, I love questions I don't mind questions that are specifically about what I'm talking about, is saying above the rising 50-day. Ideally, you would like to have it in an upward trend, but keep in mind it's not a necessity, because when you're coming out of a bear market or a bigger correction, it's going to be declining by nature. But when you get those follow-through days, so to me, ideally, yes, you'd like to have it upward trending, but it's not important around inflection points in the markets because you're going to get follow through days after a correction with the 50-day being declining. So ideally in one of those power trends or uptrends, yes, it would be a rising 50-day, but it's not. Some people say, well, the 50 days declining, I'm not going to touch the markets. Well, it's declining because we just came out of a big correction or bear market. We had follow through days and stocks are setting up. So my point is, don't feel like it's declining, so I have to be out of the market. It depends on where we are in the cycles of the markets, and a very, very good question. So for people who hopped on late, one of the goals of my educational product is to keep people on the right side of the markets. So that's basically a check there. I've been doing it over 5 years. I think I've done a great job and I've even publicly put a lot of stuff on my blog or through TV appearances or IBD Live or whatever media I'm doing, basically saying, okay, this is a healthy market or this is a corrective market. And that's one of the main goals, because you want to invest or trade, for the most part, for me at least, when the wind's at your back. So let's make sure the market's healthy. There are 4 signs of a healthy market. I just showed you one simple sign: above or below the 50-day. Now, let's move on to the next step. The market's healthy. We're above the 50-day. Things are good. Again, this is for people who like to buy individual stocks or trade individual stocks, maybe swing trade. Swing trade is all varying types of time frames. Some people say swing trading is 2 to 3 days, 2 to 3 weeks, 2 to 3 months, 2 to 3 quarters. Who really cares? That's not the point. For people who either like to buy individual stocks, trade individual stocks, when the market's healthy, at least give your shot with the next step of, let's just find some great fundamental names, meaning that William O'Neill and his team did a study of the characteristics of the greatest winning stocks before they made their big moves. One thing I want to stress in this slide is before is underlined, capitalized, and bold for emphasis, because these are the studies of what did Microsoft look like before it became a big winner? What did Cisco look like before? What did Brunswick in the 60s look like before it went up 1,200%? Before NVIDIA went up? You get the point. These are the studies of what stocks, big winning stocks, look like. In other words, if you want to learn the best, study tapes of Michael Jordan so you get a blueprint of what one of the best looks like. So study some of the best winning stocks. And the point here is, it's almost common sense, but a lot of people don't realize, for the most part, what causes a stock to go up is you're growing your earnings and sales, and you're growing it at 30% or better quarter over quarter, meaning explosive growth. There are companies that are a little bit more mature, again, not picking on Apple, that is so big that it's single digit growth and kind of flat growth, something like that. Then there are others that are smaller market caps that have 30%, 100%, 200% or more growth. The higher, the better. But basically, the study showed that the main reason, the dominant reason behind stocks that have gone up big is earnings and sales growth. Those are the first 2 points. There's 18 characteristics, which I cover in my educational product, but I'm just sharing with you some of the main bullet points there. And the other thing is 80% of them came from certain groups. Consumer retail, not just retail clothing, apparel, retail restaurants, Panera Bread being a monster, Tapestry, used to be Coach, being a monster, Chipotle, which went from whatever, 100 to 2,500, like not just retail restaurants, fast casual, but also clothing. Some of those names, Deckers in the past, Lululemon, some of these names that have gone up significantly. So that's one of the areas they come from. Computer related is everything, software, chips, and so forth. Drug medical, with advances in drugs and medical, some of the big pharma names. You got to remember, those were smaller biotechs before they became big pharma conglomerates and so forth. Financial, some, and then leisure entertainment. Again, don't underestimate some of the fads, even if they're fads. With a yoga boom, Lululemon did well. With the bowling and pool boom in the 60s, Brunswick did well. Sometimes it's a fad or a new, whatever you want to call it, a new form of leisure and entertainment where the stock can do well. And then strong technicals again. This is, again, I'm stressing that Before they became big winners, 99% were above the 200-day, 96% were already above the 50-day. Yes, if you're a value manager and you like beaten down names, you can say, I'm going to nibble on something that's way beaten down because you like it longer term. Nothing wrong with that. I'm just talking about the statistics and the probabilities of what I'm trying to do is, as they say, stack the deck in your favor. There is no black and white in the market. There's tons of gray, meaning a lot of people think there's an exact answer to a lot of their questions. There isn't. There's a lot of variables and uncertainties, but what I'm trying to do is increase our probabilities of success by, number one, making sure that the market's healthy and the wind's at your back and you're on the right side of the market with the institution supporting you. Number two, when the wind is at your back, let's at least give ourselves a shot by buying stocks that have the blueprint of potentially going up. It's not that you're going to nail every one of them or you're going to be perfect on every one of them, but at least give yourself a shot by exposing yourself to higher probability, prospects. For people who follow sports, when they ask somebody, let's say you're in the NFL draft or the NBA draft, and they ask the owner or the general manager, who are you going to draft with the 7th pick? What do they say? The best player available. So it's the same thing in the universe of over 10,000 stocks. If you're going to gravitate towards what stocks to buy, let's at least give us a shot of some of the best available. In football, I'm going to probably draft out of the SEC than the Ivy League when it comes to football. No offense if you are a superstar football player at Harvard or Yale, but you get my point. At least give yourself a shot with a basket of stocks. I'm already rambling. With a basket of stocks that have a higher probability of success. Now, let's move on to the next one. Somebody's saying, Joe, you're the one person I've followed for 20 years consistently. Simple, effective, proven strategy. So thank you for doing this. Yeah, no, I appreciate that. And look, a lot of this is about consistency. The market is going to throw curveballs at us and have a lot of variables over the years, but these are concepts that have been the same 100 years ago, the same today, and will be the same 100 years from now, meaning for the most part, if a company is growing if their company's growing their earnings and sales, the stock should do well. Think about this. If you have a small business and you do $1 million in revenues, and then a few years later you do $5 million in revenues, then you do $10 million in revenues, and then you go to sell your company, the value of your company has gone up because you're growing your earnings and your sales and your cash flows. It's the same concept that as companies grow, the value of their companies and their market caps for the most part go up. Now, for people who hopped on late, number one, make sure you're on the right side of the market and it's healthy. Number two, at least give yourself a shot with strong fundamental companies. Number three, now this is the line I say all the time. I don't care what your time frame is, short, medium, longer term, it doesn't matter. At least get a strong entry point, because if you buy a stock, round numbers, at $50, it would be nice in the next few days or few weeks if it's at 51, 52, 55. You breathe a little bit easier. You have a little bit of a cushion. You're building your confidence because you have a little bit of a profit versus buying something incorrectly at $50. Now it's at 35 and you're angry and you hate the market and you're stalking the company and you're stalking the CEO on social media and you're going to shareholder meetings, and now you become a long-term investor because you're absolutely angry and you didn't buy it right or didn't have a stop loss. I'm kind of joking, but my point is, no matter what your time frame is, get a strong entry point. Use the technical patterns. Some people say it's voodoo. Some people say it's hocus pocus. Again, I don't really care. Do what works for you. When you go to a doctor and you get an MRI or an EKG or an X-ray or anything, what is that? Those are technical charts of your health. What are technical charts in the markets? It's telling you a lot about the stock's health. That's the analogy. So you don't need to be a CMT, a country music technician, or whatever it stands for, certified market technician, whatever it is. You don't need to be an expert. You don't need to be, some like amazing Fibonacci master or whatever. You just need to know basic concepts. And there's 7 major concepts. I go over them in my educational product, but I'm going to go over Cup with Handle because this is the most common one. So, cup with handle. Um, a lot of people say, can you draw a cup with handle in the chart? And I used to think like, I didn't know. It's actually not that, it's not a bad question because I didn't know what it was. Just think of a coffee cup or a teacup with a handle drawn out. And that's what it looks like on the top in practice. And down below is an actual example of Microsoft. Cup with handles can work on daily charts mostly, also weekly charts. It can work intraday, where the characteristics are you have a prior uptrend, then a stock builds a base, and it usually builds a base. In the case of Microsoft, it built a base during the 90-91 bear market with one of the Gulf Wars. So don't look at corrections as a horrible thing. It's a stock is growing, and then the market goes into a correction, and the stock's like, all right, I'm just going to hang out and buy some time and build a base. So bases are built during market pullbacks and corrections or bear markets, whatever you want to call it. Then when we come out of those corrections, that's where the buy point is. And again, the buy point is as you're emerging out of these bases, you can see all of the it's all marked up when people who bought incorrectly extended at point A. When it comes back to point C, they're like, just get me the heck out. Let's say you bought this at $75 or $80 and you bought it when it was extended and already ran. And then it goes down to 50 and you're like, get me the heck out of this thing when it gets back to even. It comes back to even, and then people are like, I'm just happy to get out at break even. And that's what creates the handles, is that the handles are, you're waiting for those sellers who bought incorrectly to dry up, and then the stock is usually ready to go. And that's where you want to use a lot of these simple technical formations to increase your probabilities with strong buy points. So I'm going to show you how to build a screen based on this, but just really quick, I do run an educational product on my website at joefahmy.com. You can click on investor education, and I'm running a special promotion through the end of the month. And this is actually, as honestly as I can say this, it's not a sales tactic. I've not raised my prices in 5 years, and they're going up later this year in September. So this is the last discount I'm running, where it's normally $495 and you get $100 off for the quarter. And you also get an additional free month. But let me just really quickly say, you get all of these concepts pre-recorded. It's like Netflix. You can watch it whenever you want. It's about 4 or 5 hours of the Trading Big Winners seminar. Those live seminars I used to run, I just recorded them all with all of these concepts to take people from start to finish, when a market's healthy, through a healthy time, and when it looks to top out and corrections and so forth. I do a weekend video every Saturday where I take the concepts of the blueprint of the seminar and do my best to apply it to current market analysis. There's stock ideas, there's market analysis, sector analysis, and so forth. I do a midweek update on Wednesday. So it's kind of like, let's see what happened already during the week, and then see if there's any setups, any information to see and preview for the remainder of the week. I do some stock spotlight series, and then regular live screening webinars like the ones I'm doing now, where I take Q&A from the members. And just really quick, I want to say that the promo code take 100 off is good until the end of the month. You can sign up today or up until the end of the month, but it'll give you access until October 1st. So you're going to get the rest of May. You're going to get your normal quarter. It's a quarterly membership, June, July, August. And then I'm going to throw on, my web team will add an additional month. So basically for $395, it'll take you till the beginning of the fourth quarter. So you get basically through this summer, through October 1st. So if you're interested in more information, more content like this, I'm very grateful for the feedback I get. I've been doing this over 5 years, and I'm very grateful that I'm able to help. My main goal is to help people build their confidence. I want to promote calm, confident traders, try to help you build your confidence so that when it comes to the market, as I said, there's no black and white. There's some, but there's just a lot of gray. But by helping you to build your confidence, knowing your time frame, knowing your risk tolerance, knowing what works for you, if you're trading full time, if you're working full time and you're peeking in on the markets when you can, if you adjust your portfolio every week, every day, every quarter, every year, all the different time frames to help you build your confidence, so that the key is to be consistent, because we're in this for longevity. Anyone can make money during the COVID boom or during a great bull market, but the key is to be like Stanley Druckenmiller, Paul Tudor Jones, David Tepper, William O'Neill, some of the best that have ever done this. And what makes them the best is their consistency, to be in this for 10, 20, 30 years or longer, and to be consistently profitable. And my goal is to help people with that confidence. So again, the promo code is take 100 off, and it's good not only till the end of the month, but you'll get an additional month for free. And then again, in September, the prices are going up. It's actually not BS, it's fact. So I'm just letting you know that it's an opportunity to get a feel for what I do. So somebody's saying, thanks a lot for your podcast. You have the perfect personality for that. Look forward to more. Thank you so much for that. I really appreciate that's very, very, very kind. I'm enjoying the podcast. I'm doing my best to present not just financial stuff, but I've been very blessed to meet some very interesting people in my life, and I enjoy talking with them and sharing those stories. So thank you for that. Like and subscribe on Spotify or Apple under Joe's Happy Hour. Anyway, so we went through the signs of a healthy market, fundamentals, technicals, and what I do in the educational product. And really quick, before I get into stock screening, I have this on my website as well. And again, don't get offended. There's a million great stock books. People are like, why didn't you include this? Why didn't you include that? Like, there's a million of them that are great. These are some of the ones that have helped me, as I mentioned, how to make money in stocks. The greatest lesson in technical analysis is go through those first 100 pages of the fourth edition. It really, it's for whatever the book costs, $11.95, whatever, 10, 15 bucks. It's one of the greatest lessons if you want to put in the work. You have to work at this. This isn't like, okay, let's open a brokerage account and we're going to make it rain and make a fortune. You got to put in the work, and that's a great place to start. The Jesse Livermore books. Mark Douglas has great books on market psychology, explains this stuff way better than I do. Victor Sparandeo has some on market timing that's amazing. Nicholas Darvis, funny title, How I Made $2 Million in the Stock Market. I always joke, if you want to write an investment book, title it How I Made $3 million in the Stock Market, because that'll probably sell better. Because if I'm at a bookstore and I see how someone made 2 million and I see how someone made 3 million, I probably want to buy the one, the person who made the 3 million. It's kind of like something about Mary with the 7-minute abs versus the 8-minute abs. I don't have 8 minutes to do abs. I want to do the 7-minute abs. Anyways, hopefully you're paying attention, and if a few people are laughing, then my mission is accomplished. Battle for Investment Survival, Gerald Loeb, is an amazing book. Even William O'Neill talks about that. Literally written, I think, in the 50s. And when you read it, it applies to the markets today. Great, great book. There's a lot of great Market Wizards books by Jack Swagger. There's more than 3 of them, but I'm also a big fan of mental toughness, and that can really help. Whether I think the greatest book on trading that has nothing to do with trading, or that it has a lot to do with trading but doesn't talk about trading, is Think and Grow Rich by Napoleon Hill. Also, Tony Robbins, David Goggins. There's just so many amazing things that I love. Because again, when I talk about one characteristic of successful people is their desire to improve themselves. I'm always looking to improve, and trading can be difficult. Trading is not easy, and I'm not here to tell you it's easy, but it requires a lot of mental toughness. So I'm a fan of a lot of this stuff to feed your mind with as much strength. Think about it as building a muscle. You have to feed your mind with a lot of mental toughness and positive things. It's not positive thinking or positive thoughts. It's training your mind and conditioning your mind for the mental toughness that's needed to deal with the variables and curveballs and everything else that's thrown at you as we try our best to navigate through the market. So, all right, shut up, Joe, and let's go to the screens. So let me pull up MarketSmith. This is live. Bear with me. Let me share MarketSmith, share screen. Hopefully I did it correctly. There we go. Somebody saying, good morning. I sent you some questions to your email. I did not get, I didn't check the email before I did this. So if you want to ask them, you can. Somebody's saying, good morning, Joe. Thanks for the session. Somebody's saying about market breadth. And so we'll get into that in a minute. So thank you for your questions. I just want to get through the screen. Okay. So because I promised as the structure of this, I'd go through the slides, show you how to build a stock screen, and then let's do some Q&A after that. So this is the second part of showing you how to build a stock screen. So before I show you the screening, I want to explain why. I screen to get a feel for the markets. It really, to what it boils down to is it really helps shutting out all the noise and all the news. Because I like that phrase, don't focus on what you think the market should be doing, focus on what it's actually doing. And by screening, you get a feel for what it's actually doing. I go through about 500 to 1,000 stocks every single night to get a feel for the markets. I have a whole bunch of screens here for the educational members. If you use Market Surge, I don't use all of these. Some of them are just old and I haven't looked at, but I include what's in a lot of these screens. And if you sign up for an educational, as an educational member, and I also want to make a couple of other points here. So many people think that this is like the Wizard of Oz and the magic behind the curtain. What's in your screens? What's behind the curtain? It doesn't matter what's in the screens. Mike Webster, who is a dear friend and I respect tremendously, he's always being resourceful and playing around and building new screens. They're not that complicated. Stop thinking that I'm going to plug in 3 variables and it's going to give me all the magical stocks. It's playing around with it, being resourceful. This 30 for 30 screen is very, very simple. It just plays off of what I just showed you. Relative strength from 1 to 99 and I call it Market Smith. It's Market Surge now, but it's just habit. I've been using Market Smith forever. In the Market Surge database, you can see there's over 10,000 in the top right there. Over 10,000 stocks. They're ranked from 1 to 99. Let's just take 90 or above. Just like a college is probably going to take people who scored on their SATs 90 percentile or above to try to take some of these smarter students, unless you're really good at sports. But anyways, try to gravitate towards some of the better stocks by 90 or above. William O'Neill used to say he wouldn't buy anything below 80. Some people like it, like the higher the better. It doesn't matter. That's the whole point is I just picked 90 because it gives me the top 10 percentile of stocks that are acting well based on their proprietary ranking. And then I took sales last quarter greater than 30%, earnings last quarter greater than 30%. And then I just chose $20. You can choose 5, you can choose 40, you can choose 100. It's not exactly a what's the word I'm looking for? It's not like there's some magical number. You can play around with this. I'm stressing the point that stop thinking like I need to know what's in someone's magical screens. It's not a pet peeve of mine. It's just really trying to impress upon you that just be resourceful. Think outside the box, play around with it. But where does this 30% sales come from and 30% earnings come from is when I go back to my slides here. If you could bear with me for 1 second. And let me go to share and let's go back to the slides. Hopefully I'm doing this right. There we go. For people who hopped on late, you make sure the market's healthy. Then when it's healthy, where does the 30-30 screen come from? Stocks that have based historically on the studies, stocks that have been characteristics of the greatest winning stocks is 30% year over year earnings growth, 30% year over year sales growth. That's where it comes from. I'm building a screen. Let me go back to Market Surge. I'm building a screen based off of probabilities and historical studies. That's where, the 30 comes from there. The 30 comes from there. Give me 1 second. Let me grab some water. Okay, I'm back. Sorry if I'm going too fast. There's just a lot I want to cover, and I want to leave time for questions as well. So let me, and then that produces from the database there, that produces from over 10,000, it produces 57 names. Sometimes the screens produce 300, sometimes they produce 5 or 10. Play around with it. Maybe if you want more names, you can go greater than $20. If you want something that trades, I put something that trades average volume 200,000 shares. I'm not Fidelity Contra Fund where I need to buy billions and hundreds of thousands of shares, but I want something that's fairly liquid. I think some people change that to 500,000. It doesn't matter. My point is be resourceful. Great question here. Somebody's saying, when you speak about growing earnings, do they have to be positive or just growing? Awesome question. They can be negative and growing better from negative to positive. When everyone hated Amazon years and years ago, remember when every short seller hated it? They're not making money. Nah, nah, nah. If you looked into it, they've been cash flow positive since 2003. They've just been reinvesting in their business for over 20 years, but they were going from negative earnings to slowly being positive. A lot of software companies, they build their infrastructure, and then as their profit margins expand and as their subscriptions start to build, they go from negative to positive. So yes, it's not just growing their earnings. It could be less negative growth until they eventually become, whether it's cash flow positive or earnings positive. So awesome question there. So before I get into the screen, it produces 57 stocks. Let me make a point here with why I screen and show you something around the COVID low. This is very important for me because this is March of 2020 during COVID. Okay. And it's a very important point I'd like to make. During this time was horrible. Once in a century pandemic. Everyone was going to die. We're all stuck at home. I'm not being flippant or whatever. I'm just saying clearly it was a very emotional time, and the market dropped. I think it was 32% on the S&P and 30 to 40% on the NASDAQ and the Russell, literally in 3 weeks. Okay. And it was the end of the world, but I told you I'm screening every single night, trying to get a feel for the market. Why do I do this? To shut out the noise. And notice how news and noise sounds a lot similar, and they're spelled with a lot of similar letters in news and noise. Anyways, I wrote an article, 2 articles for Yahoo Finance, literally saying towards the end of March, and I wrote another one because I was really adamant about this in early April of 2020, saying just because the coronavirus numbers are going to get worse, it doesn't mean the stock market has to get worse. I got ridiculed like you wouldn't believe. I don't care about any of that. I'm telling you this story because I wrote that article, and I don't want to say put my reputation on the line because that sounds like too much of a drama queen, but I had the stones to write that article for one reason and one reason only. I was screening and I was saying to myself, the market's not that bad. Yes, the news is horrible. And if you were glued to the news, you wanted to and you're trapped at home, you're going crazy. But if you remove those emotions, if you reduce those emotions, if you shut off the news and didn't let it program our minds, which is what the news does anyways, that's a different topic. But anyways, I just was screening and I was saying, you know what? The market's not that bad here. I'll give you an example. I'm going through some names. I'm going through DocuSign and I'm screening Perspective, end of March, early April 2020. I'm going through and I'm seeing, going back to the cup with handle, I'm seeing a cup with handle on DocuSign and I'm like, that actually looks pretty good here. I go look at Zoom and I say to myself, okay, it already went to new highs and it was coming out of a big IPO base on the weekly chart. It already came out of a big IPO base. Look at that. March of 2020 was coming out of that IPO base before it went from 80 or 100 to close to 600. Okay. And then you might say, okay, yeah, Joe, DocuSign and Zoom and Coupa Software, which went private, so it's not on the market surge database. You might say this is all work from home stuff. Fine. Fair point. But Seattle Genetics, which also got bought out by Pfizer, was making a new high in early April. DXCM, a medical products name, which is glucose diabetes monitoring, was coming out of this base here. Look where this is, early April of 2020. So it wasn't just work from home. It was some biotech with Seattle Genetics. I think it was April 6th. I literally don't remember what I had for dinner last night, but I remember on that follow-through day on April 6th, Seattle Genetics made a new high. I wish I could show the chart, but it's no longer in the database because when they get bought out, they're removed from the database. Anyways, it was work from home, Seattle Genetics, biotech, medical products with DXCM. And then look at this weekly chart of Amazon. Look at Amazon moving out of a big base. Where was this? Look at this, March, April of 2020. What else was there? Netflix, another one. Look at this, coming out of a 1-2, we'll call it a 1-2 year base. Big weekly base. And look where it started to come out there. March, April of 2020. NVIDIA was May of 2020. Again, don't ask me why I remember this random stuff, but NVIDIA already made a big run, built a big base there, and look where that came out there right around May of 2020. You combine that with, on the daily chart of the NASDAQ, that April 6th follow-through day there. That's a follow-through day. I was actually doing the product around that time and identified that. There was actually one on April 2nd on the S&P 500. When you go to the S&P 500, that actually flashed a follow-through day there on April 2nd, and then both the S&P and NASDAQ followed right there on April 6th. Sorry if I'm rambling. Hopefully you're paying attention and keeping up. My point is that I can't think of a more, like, in the most recent history, a more extreme example of why screening helped me. It's COVID. We're stuck at home. Everyone's going stir crazy. We don't know what's going to happen. We're locked in our houses, and I'm screening, and I'm like, yeah, the news is miserable, but the market looks pretty good here. Who cares the reason why? Obviously, it was the Fed taking rates to zero and pumping in more liquidity than we've ever seen in our life, because the Fed made sure that they weren't going to let a once-in-a-century pandemic ruin the entire world. They bought more bonds in the 6 weeks following the pandemic than they did in 9 years from 2009 to 2018. I'll say that again. The Fed bought more treasuries in 6 weeks than they did in 9 years combined coming out of the financial crisis, QE1, QE2, TARP, TALF, Twist, Operation, whatever it was. My whole point is that who cares the reason why? It showed up in the charts. And that's my sort of 5 to 7 minute sidetrack of why I screen, because it really helps. It really helps. No different than today. End of the world, tariffs, and I can't stand this, and who cares what you believe politically, and all the tariffs are ruining my 401k and ruining the markets and this and that. And then all of a sudden you get a couple follow-through days on April 22nd, 23rd of this year, 22nd and 23rd, yep. And then you get a Zweig breadth thrust, basically showing institutions are coming back in. My whole point is, if you watch the news less and got off of social media and reduced a lot of that crap and just paid attention to what was going on in the markets and screened a little bit, it would really help you with clarity and help you see things clearer rather than being affected by what douchebag trader 69 is saying on Twitter. It's so much easier to pay attention to what the market's actually doing. So hopefully you're still with me. Shut up, Joe, and go back to your screen. So I go to the screen here, and if you have any questions about screening, or if anything I just said doesn't make sense, or you want more clarification, please send them over to the Q&A. This is the opportunity to ask, like that question about, negative to positive earnings and so forth. Please fire away if it's specific about what I'm talking about with screening. So now this screen produces, I'll update it, it produces 57 stocks. And now is where I go through to get a feel for the markets, to get a feel for sectors. I'm paying attention to what sectors are showing up. I'm going through it's not necessarily to get an idea to trade, not Monday because the market's closed here in the US. It's not, I say Monday, 9:30 Eastern. It's not necessarily to have an idea to trade when the market opens this next week upcoming. It's just to get a feel for the market, to look at bases, to pay attention to what sectors are showing up, what are consistently showing up, to get a feel for if the market's breaking out and breaking out on good volume and breakouts are holding, when in the corrective markets, breakouts are failing. Just to get a feel for what type of stocks are showing up, what type of sectors, where they are, relative to, moving averages, seeing if stocks are breaking out overall, just looking, getting a feel for the markets. If something's working on a new base, trying to, let it symmetrically form a new base. The more stocks you look at, the more screen time, paying attention to, a name that's breaking out and holding its breakout. After a breakout, if a stock moves higher and barely gives anything back, I'm not saying to buy it. That's why the disclaimer, this is not to buy any of these names. It's just to get a feel for what's looking decent, what's holding up, just sectors and so forth. And then just going through to get a feel. I go through this quickly. I'm just going through it a little bit slower, but looking, paying attention to bases. The more screen time you put in, a lot of people like when I draw these bases, the more screen time you put in, not screen time, but the more you look at charts, you'll slowly develop, like just through experience, like a photographic memory of history doesn't always repeat itself. It tends to rhyme. You'll get a feel for, oh, that looks like a base or a cup with handle, or this could be a double bottom, or, you get a feel for it by looking at some of these things where, CyberArk, this is an example of going from negative to positive, where it broke out. And then what happened in mid-February, the market went into a correction. And what happens during corrections? Stocks build bases, and then they had a nice earnings report, and it's building the right side of the base. These are the types of things that I'm paying attention to when I'm screening to really help me with clarity in the markets. There's some questions coming in. What do I think of the market for the next 3 months? I mean, join my educational product. It's so much easier than. I think a lot of people just want to know, like, literally what I think about the markets now. That's not what this is about. It's not a pitch to get you to join the educational product. It's to show you this is about education. This is about trying to educate people. I know people are like, I want to know what's going to happen on Tuesday. That's not what this is about. I appreciate the questions, but that's why I take the blueprint of all this and I update people regularly through my educational product with a lot of this. Do I think the market's going to retest the lows, this and this and that? That's not what this is about. This is about trying to educate you on. That's why I said if you have questions about screening in particular, this is another one where Dave formed a high tight flag and I thought it was ready to double coming out of this. It started to move. What happened in mid-February? The market went into a correction to held it back. The second the tension was relieved off of the markets, I was right that it was going to double from 90 or 100 to 200. It just did it afterwards because the market held it back. That's what I mean by don't get discouraged when the market's correcting. Sometimes there's stocks that have great growth. You can see the explosive growth here going from negative to positive, earning $2, earning, this is triple digit growth and triple digit earnings and 30-40% sales growth. But the weight of the market just held it back. A little tension relieved off the markets, and then it went higher there. So that's why I go through these screens to get a feel for, what sectors are holding up well and what charts look like. And again, it's not like, hey, go back. What's that look like? I want to buy this or that. That's not what it's about. It's just to really get a feel for the markets and looking for maybe pullback buys if stocks are breaking out, holding their breakouts. And these aren't the only magical stocks that are going to show up. These are some that, what do they have in the last quarter? Over 30% earnings and sales growth. That's all it is. Looking for names that are growing and to at least give yourself a shot. I do look at weekly charts as well. I just try to get a feel for, some of the nuclear names were coming back around. And then Trump said that he was going to do something with the nuclear news came out, more reactors using nuclear energy, favorable, whatever you want to call it, favorable news for the nuclear names. And then some of them popped, but they started to set up ahead of that. So that's basically what I'm going through just to get a feel for that. Sometimes you'll see a stock building a base and then magically some news comes out. That happens as well. So, Robinhood, why is this done well? Again, they went from negative to positive, and then look at that, 600 million, over a billion. I mean, that's explosive growth as breaking out of a base. They run up. What happened in mid-February? The market went into a correction, kind of a double bottom there. The tension's relieved off of the markets. It's still growing. Again, this isn't a buy recommendation. I'm trying to show you the blueprint of why stocks go up. They're growing their earnings and sales, period, end of sentence. They went from, doing 400 million a quarter to over a billion a quarter in revenues. They've gone from negative earnings to positive cash flow. So that's what causes when you say, why is it going up? They're growing, dummy. That's it. It's plain and simple. I'm not saying you. I'm saying don't overcomplicate things. Why are things going up? Because for the most part, the markets grow. The markets, the stocks are growing. Something like rubrics. Look at this. A few quarters ago, 135, 150 million, 175. Then look at this year, 205, 236, 258. So they've gone from 135 to 258 million in revenues. They're growing their earnings and sales, going from negative to positive. That's an example of the growth is, from negative 52 to negative 18 to that person who asked that question. It can be growth from negative to less negative as cash flows increase and the earnings start to flow in. That's why the main driver behind these, and it's my passion, I get very passionate about finding some of these names to really can help you with outperformance and can help you if you like to trade individual names. So that's kind of what I'm going through. It's 57 names on this, just to get a feel for, we saw some metal names, we saw some software names in there, we saw some energy names, helps you get a feel for, some of the, sectors that are doing well. Somebody's saying, thanks for this information, Joe. Really appreciate it. Question, does decreasing triple digit or decreasing double digit growth a concern? Sometimes it is. That's a fair point where, something like NVIDIA, let's see here. Let's take a look. Like NVIDIA was explosive growth when they had all the big surge with their chips where it went from 455 to 152 to 103 to 71%. Still insane growth for a company doing, close to 200 billion in revenues. But I think that's what your question is. Is it a concern when it's growing, but it's slowing its rate of growth? I mean, that's probably why it's consolidated for the past year. I mean, this is basically May, June of last year. It's been consolidating because a lot of the growth was built in and it's still growing at a slower pace. It depends on the direct answer is it depends on the situation where sometimes the market or a stock just needs to digest some of it and it continues to grow and continues to build its market cap and continues to build its presence and so forth. But and sometimes it might slow for a little bit and pick back up. But the whole point is Wall Street wants to see growth. And just keep in mind, sometimes it's called the market's a discounting mechanism. Why it grew like crazy over these years is because the market was anticipating or forecasting the growth. And then sometimes when the growth shows up or slows down, it just consolidates for a bit. I'm not saying the story's done by any means, but it's a fair question. So it really depends if it's decreasing triple digits or decreasing double digits. It could just cause the stock to digest for a little bit after a big move, if hopefully that makes sense. So let me go through a little bit really quick because somebody asked me the discount code. Let me just go back to this really quick. If you're interested, I'm going to stick around and take questions and go through charts and so forth. Like I said, I'll stick around till the open on Tuesday. The market never sleeps, because especially if you're in crypto. Anyways, in my educational product, I do tons of content like this. Hopefully you're feeling how passionate I am about the markets, because really it's my main goal. I always joke I have a million goals with my educational product. The main goal is to help people build their confidence. Really, that's what it comes down to, so that you can build your be calm in the markets when there's a lot of noise. Be confident when you're unsure or you like a stock and an analyst downgrades it and you don't know what to do. I want people to help build that confidence. So I produce content twice a week, sometimes 3 times a week when I run live webinars. There's a promo code that's good till the end of the quarter. Take 100 off. It's the last time I'm doing a discount at this price. It's normally $4.95. I know it sounds like such a shitty sales thing. It's just the truth. I'm just being honest. It's $4.95 a quarter. The price is going up to $5.95 in September. So this is the last time it'll be a discounted at the $3.95 price. And you get an additional month. You not only get the rest of May, you get June, July, August, and you get an additional month where my web team will add September. So basically, it'll take you through October 1st of this year. And if you're interested, you can go to the website, joefahmy.com, and click on Investor Education. And again, what you get is you're going to get access to all of this content that explains these concepts in the seminar, weekend videos every Saturday, midweek videos by Wednesday. And then I do regular screening webinars just like this to take questions from members. So if you're interested, the promo code is take 100 off. You can use it until someone asked me what the promo code was. You can use it until May 31st. So let me go back to charts here and let's go back to, and again, now I want to open it up for questions. If you have any questions, send them over to the Q&A. If it's about any individual stocks, I don't mind taking a look at it. Just give me a little bit of time frame. I can't give investment advice. Just let me know. I'm going to guess if you're going to ask me about XYZ or ABC stock, it's because you own it. But just give me a little time frame or a little bit of a description, not like, hey, Monkey, can you look at XYZ? I appreciate if you address me as Mr. Monkey. It's at least more polite. It's like in, what's that movie? Wedding Crashers, just make me a bicycle clown. Instead of, hey, Joe, can you look at all of these stocks? Just tell me, hey, I'm in this stock. What do you think? This is my time frame. Or I'm looking to get into this ETF. What do you think? I don't mind doing that rather than just say, hey, look at this. Like that doesn't help me answer anything. But part of my routine when I go through my weekend work is I'm going through the NASDAQ. Are we above the 50-day? Are we above the 200-day? We had those follow-through days. We had those several breadth thrusts, including that Zweig breadth thrust, which I covered in the videos at the end of April. And then we gapped back up above the 21-day. Then we gapped back up above and just had sort of a normal pullback this week on some light volume. Overall, we're in a good trend and stocks are acting well. Where we go from here, I honestly don't know. Nobody knows. Maybe we're in a range for a little bit. I'm open-minded. When I approach the market, I'm very open-minded. Maybe we retest the lows. I don't know. I don't think so. But I could also see after a big move from 15,000 to 19,000 on the NASDAQ composite, I mean, a range wouldn't be that surprising to just consolidate. But Joe, I want the market to go up every day and I want my stocks to go up every day because I want to make money every day. No shit. That's what we all want. But number one, that's not how the market works. Number two, the market doesn't care about us. And number three is you have to be able to accept normal price action. Just like when I showed you Nvidia went up 1,000,000% and consolidated for a year. That's pretty normal price action. Like something like Square, which is Block, back here, it went up huge and then just consolidated for a while. That's normal. Sometimes stocks continue their growth prospects. Sometimes the growth slows down. It's that word acceptance. You have to accept that the market is going to be unique. Not every stock is going to be an Amazon or an Apple and go up forever for 20 years. Those are the exceptions to the rule. So understand and accept the way the market works. And I always talk in terms of probabilities and statistics. So what else do we have here? Best industry group in the near term. That's a great question. When I screen, I narrow it down for my educational members. I would say, aerospace and defense is good. Software and semis is good as far as growth groups. There are others, of course, in the energy space. especially like all related to data center, whether it's nuclear or utilities powering the data centers. But those are some of the nice themes that I've been finding as far as different industry groups and sectors that are doing well. Um, How do you handle market volatility from the impact of the dynamic change on tariff? It depends on where we are. When we're below these key moving averages, when you break below the 50-day, below the 200-day, volatility will increase. So I will, because I manage money actively for clients, I will reduce my exposure to handle that volatility. To reduce the volatility, I'll raise cash because when the market goes through a corrective phase, and you're getting 2% moves or more every day, I will reduce my exposure and reduce my normal position size to help deal with that volatility. When the market's healthy and we're in these really nice power trends, because the market gives us 2 to 3 times a year where it gives us those nice power trends, that's when I don't want to say I'm complacent, but I'm not worried about volatility when we're in those power trends because the wind's at our back and you can increase exposure and increase position size. So I vary my levels. I'm not saying it's easy by any means, but that's how I handle volatility is usually the volatility comes when the technicals are breaking down. So the way you deal with it is by lower exposure, lower position size, if that helps. Same thing with some stocks as well. Some stocks, Jesse Livermore says some stocks are like people. Some are more volatile, some are more calm. If you see a stock with a crazy range, use a lighter position size, meaning there's a difference trading Nvidia versus trading AT&T. There's a difference trading Netflix versus ExxonMobil. They have different characteristics and have different ranges. Some might move 1% a day, 0.5% a day on average. Some might move 5 or 10% a day on average. So you have to understand the characteristic of the stock you're trading, and you can adjust your position size so you don't get chopped around. So if a stock moves 5 or 10% a day and you have a 5% stop, you could get chopped around every single day in it. But if you have a lighter position, it can help you stay in something like that. So it's called adapting to what, the character of the stock. Let's see what else we got here. There's a lot of questions coming in. Somebody said, thank you for that. No problem. Uh, Somebody's asking me for a podcast request. I will do my best. A lot of people are saying, hey, get this person on, I'm doing my best. I'm doing my best. I appreciate the requests. Just be patient. I'm trying to get, like, someone's like, you haven't had this person on. Take it easy. It's not my job. I'm doing my best. So thank you for the request. I will try. Joe, thanks for sharing what you do. Your comments on the recent IPO CoreWeave revenues are growing good, but as a stock reach, yeah, CoreWeave, that's another example. Why did the stock go nuts? They did 37 million in revenues. Most small businesses, like 95% of them, don't even get to a million in revenues. They got to 37 million and then accelerated over the past few quarters to over 980 million. It's explosive growth. I don't remember. Nvidia has been incredible growth. Zoom during the pandemic was doing insane growth, but I can't remember a stock with that type of an explosive growth. So again, when the stock is growing, it built a really short IPO base and took off. So I love CoreWeave fundamentally as far as the growth prospects, as they're taking market share away from the the AWSs and Azures and Google Clouds of the world, as they're building a lot of their data centers and a lot of based on NVIDIA GPUs and so forth, as they're one of NVIDIA's largest customers. I think they have like a 26 billion backlog and so forth. So, but this is the part where it's run a lot, and I'm all about getting strong entry points. Maybe it forms a high tight flag up here. You're going to have to review that definition and see if it does that over the next few weeks. But this is the part where it's run a lot, and I love the growth, but I actually traded it earlier. I wish I held on to it, of course, but my point is that this is where I'm a big fan of entry points. So could it keep going and keep running? Possibly, but I would rather wait for a consolidation after this move. And I don't have FOMO, which is fear of missing Oprah. No, it's fear of missing out. I don't have FOMO. FOMO, as David Ryan once said, is for the weak. FOMO is for the undisciplined. You got to remove fear. You got to remove fear out of your life, period, end of sentence. But you got to remove FOMO from your trading. So if you see it running and you feel like everybody's in it and all the people on social media and blah, all the garbage and the noise, stop worrying about that and don't have FOMO if something's run. If it runs and I'm waiting for a consolidation, if it consolidates and it can get me back in, great. If it runs without me, it's okay. There's plenty of other opportunities and I'm in plenty of other names. So hopefully that helps answer that question. Joe SPY had a successful retest of the 200-day on Friday, but RSP lost the 200-day. I think RSP is the equal weight. Let's take a look at that. RSP, yeah, the equal weight, because it is a lot weighted on the NVIDIAs and Microsofts and Teslas that came back, which is why the S&P, regular S&P, is doing a little bit better than the equal weight. Let me read the rest of the question. There were 4 distribution days this week, and the relative strength line for XLP to SPY has been, let's see, I mean, this is more of a specific, I don't see 4 distribution days this week. I see on the NASDAQ 1 there and a slight 1 there. I see 2 on the S&P 500. I see 1. I just see 1 this past Wednesday because we were flat on Thursday and then we were down Friday on lighter volume. So I don't see, I use the overall volume on the index, not the ETFs. So I see 1 kind of a slight 1 on Friday on the NASDAQ, and I so 2, and I see 1. I mean, after the follow-through days to run up this much and see a day or 2 of distribution is, I'm not complacent. That's not alarming for me. It's when you see a cluster of them show up. So as far as exposure and all that stuff, that's more of like specific investment advice. And I don't want anyone copying what I'm doing, whether I'm 10% invested or 200% invested. What does it matter? It doesn't matter. I want you guys to develop your own style for what works for you. So there's part of that question that's a little bit more specific investment advice. So I'll leave that up to you. But as far as the markets, after a big run, the S&P pulling back to the 21-day, it seems like normal price action to me. So I'm not complacent. I'm not also like going to live in fear over 1 distribution day after a big run up. It's not a concern. Palantir is said to be grossly overvalued. Palantir is growing like crazy. And there's a lot of bullish call flow. I also pay attention to unusual options activity, which I do discuss in my educational service. But yes, overvalued. I mean, PE doesn't matter during good markets. It matters in corrective markets. And again, full disclosure, I own it. I have a full position in this one. I'm in from a lower level, but it made a big run. It's sort of, if you want to call this a double bottom, and now it's just building a handle. Looks pretty normal to me. That's why I think PE is one of the most grossly overused measures that I mean, you get what you pay for. No one complained when everyone complained when Apple was 80 PE before it went up 3,000%. Now it's one of the most widely held names. So, you know, some names trade at higher PEs because you get what you pay for, meaning you pay higher price, a higher premium for explosive growth. So to me, the valuation is not a concern. If it's a concern, you'll see a breakdown in the technicals, if that helps. Let's see. Someone's saying recommendation on where to start with your educational content to gain more confidence. I think it's just that's a really good question. I have to think about this one. And someone's also asking me for the discount code. So while I'm thinking of that question, let me go back to this. The discount code is take 100 off, and it's right there, and it's good until the end of the quarter. End of the month, May 31st, and you get an additional month for free. So my web team will add an additional month, so it'll take you through October 1st. Anyways, recommendation on gaining more confidence. I think it's gaining knowledge on how the market works probability-wise, statistically. Yes, there'll be some curveballs. There'll be some tariff news. There'll be COVID. There'll be a debt downgrade. There'll be wars that happen. There'll be geopolitical stuff, interest rate stuff. The market's not easy. The point is that when you understand the institutions control the markets, so being on the right side, when you understand when it's healthy, being in stocks that have strong earnings and sales growth to what? Give you a shot, give you at least a hope, a chance of doing well. That helps build your confidence. When you understand technicals for entry points, when things are breaking down and the institutions are no longer supporting it, and you say, you know what, if the institutions are blowing out of this name, I probably should get out of the way before they run me over. To understand a lot of these concepts, that to me is what helps me build the confidence, because I respect a lot of people. I highly respect a lot of people, and I'll listen to what Stanley Druckenmiller, Paul Tudor Jones, some of these people, David Tepper, who have been consistently profitable. I will listen to what some of them have to say, but if I have a certain feel of the market and someone else comes out like Carl Icahn, who I respect, says danger ahead, or Stanley Druckenmiller might say, hey, I could see a 50% drop in the markets. While I respect that, what gives me more confidence is knowing the way the markets work and saying, well, okay, I respect that opinion, but what gives me the confidence is knowing the technicals and saying, okay, while I respect that, the technicals are telling me something different, so I'm going to pay more attention to that. Meaning, like when I gave that COVID example, COVID could cause, you know, a lot of noise and a lot of havoc, but when the technicals were telling me the market health was improving, that overrode the news or somebody else's opinion. So that's what helps me to gain more confidence. Is the more, you know, knowledge is power. The more knowledge you have, and it's a really, really great question. That can really, really help. How can educational product members directly interact with you during a typical week? Great question. I do the regular webinars because I can't answer specific emails. It's not a concierge service. It's not investment advice. If people are interested in opening a managed account with me, then you can email me on that. But this is not to be meant as hand-holding throughout the week. And I want to make that clear. I promise regular webinars, as I say here, regular webinars, I promise it once a month. I probably do it every 2 to 3 weeks. That's an opportunity like we're doing now for people to interact. But I want to make it clear, it's not a concierge service where every day or every week you're going to email me, Joe, what do you think of this? What do you think of that? What do you think of this? It's really, at the end of the day, to show you a blueprint to help you build your confidence. So I'm not saying that to be difficult, like I don't want to talk to people. I just don't have the capacity to talk to all the members and to handhold people through trades. So I can give you guidelines and do my best to provide what I believe is very strong and sound analysis. But at the end of the day, you have to be able to make your own decisions and be able to decide these things on your own, so you're not relying on me or anybody else. So to directly answer your question is, it's a lot of just watching the videos and the market notes that I put out and stuff like that, if I put out any memos, but mostly it's through the video content. But it's not like I can't personally answer questions on a regular basis for people. But that's why I run the webinars to allow people to ask questions during those regularly scheduled webinars. Somebody's saying they're very bullish on, and again, that discount code is take 100 off if you want to sign up. Let me go back to Market Surge. Share, where is it here? Share, sorry, this is live. I'm just, there we go. Back to Market Surge. Somebody said they're very bullish on ODD. Are you down with ODD? Yeah, you know me. Oddity Tech, Israeli-based company based in cosmetic beauty products. Somebody's saying, how should you be concerned about the gap down? It ran up on great news, big breakout on their earnings, and then they did a secondary offering. It's very common when a company is growing and the institutions might want more shares, or it's an opportunity to raise more money. Sometimes the big institutions like, we want to build a position, but it's not liquid enough. Sometimes they just want to raise more money and take advantage at a high price. But for whatever reason, it's common with a company is growing. I remember Green Mountain did like 3 or 4 secondaries when it was growing, coming out of the financial crisis in 09 and 2010 and 11. So I'm not saying to not be concerned, but it got extended. It pulled back on the secondary, found support around that green line, that 21 day. Looks to be okay. I don't know enough about this fundamentally, but if it gapped down and recovered, I like when stocks, I don't like when they gap down. I like the reaction when it's positive, meaning it's basically recovered pretty much all of that, gap down from 70 and pretty much got it all back. So it's not the news, it's the reaction to the news, and the stock's reaction so far is healthy. Joe, great webinar. Thank you. I've recently taken a position in Webull. I plan to hold it longer term. I also have Robinhood. I think it may follow a similar path. Would you mind taking a look at it? Can you just give me the symbol? I know it, think it went public, and somebody's saying, thank you so much for doing this. No problem. I know it went public through a SPAC. I don't know. I probably could type in. I don't know the symbol off the top of my head. Let me see if it shows up here on Webull. Is it just bull? There it is. Somebody's saying bull. Thank you. I don't know enough about this one. It was a SPAC that went public, and I'd have to probably look at a different chart, like a 30-minute chart to look at it, or a 60-minute chart or something to take a look. So it went public off of a SPAC, and then it's just been drifting. I don't know enough about it. I don't BS people. If it's something where I don't follow, I didn't even know the symbol. That just shows you I'm just being honest. I can't know every symbol of 10,000 stocks, but I don't BS people. If I don't know enough about it or I don't follow it, I'm just going to say I don't know. I don't have a strong opinion one way or the other. So, and of course, best of luck to you. And like anything, just do your best to manage risk as best as you can. Somebody's saying, let's see. Someone's asking me about an annual membership. I do not offer an annual one at this time. So thank you for asking, though. I do not offer one at this time. Someone said TEM. Full disclosure, I do own TEM for clients. And Nancy Pelosi said she was buying it here. Yeah, I talk about Druckenmiller and Paul Tudor Jones and Tepper. I forgot to include Pelosi as one of the best. Joking, but not really. She bought it there and it ran up like crazy. The market went into a correction. And then, but more importantly, again, look at this, 132 million in revenues, 136, 147. And then this year it's accelerated with a big jump, 75%, as they're doing 255 million AI applications for healthcare and so forth. Ran up, held its 21 day, ran up, held its 21 day this week. Looks okay. This is an example of a stock that tends to move, I don't know the average true range, but it moves, 5 or 10% a day. So rather than getting tossed around, get a strong entry point, maybe it's not investment advice. I'm just trying to help people. It clearly moves a lot. I mean, it goes from 30 to 90 back down to 30 or 40. Clearly it has wider ranges. When you see a wider range, you either pass and say, I don't want to own it, it's too volatile for me, or you say, maybe I'll take a lighter position so I don't get tossed around and I'm getting stopped out and buying it in, stopped out, getting back in. A lighter position can help deal with that. But I like the story. I'm in it, full disclosure. That's basically what I can say on that. Somebody said GEV. Also, I love your sense of humor. I try to keep things interesting. I try to keep things engaging as best as I can. Because if I sat here monotone and said, okay, let's look at the stock market here, you guys are all going to fall asleep and snooze and leave. I don't like boring people, so I don't want to be boring myself. So I'm trying to be engaging, have a smile, be encouraging, have a little bit of a sense of humor. Even if you're laughing at me, that's fine too. So thank you for that. GEV, I'm in from a lower level. Again, full disclosure, I do own this one for clients, but this is an example of even Elon Musk in his interview with David Faber this week. And, Larry Ellison, some other people have talked about, the data center is still Powering, it used to be 1%. It's estimated to grow to 4 to 8% of the entire electric grid and so forth. I'm not an engineer. I'm not a scientist. The basic concept is data centers are using power. That's why Vertiv, the cooling, is helping with that to cool some of that down. And it's consuming a lot of power. So even Elon Musk said it's still a concern, which is why, Trump's trying to open up some of the nuclear stuff. And then you started to see some of those nuclear names go up, like NNE and SMR. There's a whole bunch of them that shot up on Friday. Why Vistra has done well over the years. It was one of the biggest winning stocks in the S&P last year. CEG, there's so many of these that are coming back around, but GEV is one of the leaders. Also in that space, full disclosure, I own it. This is an example of it's just too extended from a proper base to enter it. Yes, could it keep running? But I'd rather get it closer to 21-day pullbacks or some sort of a pullback or a consolidation if it does it. I'm in from a lower level, as I mentioned, but I do like this one into year end, so I think it'll do well. How did you find TEM? Which screen did it appear in? Great question. I don't know specifically. It might have been in one of my relative strength screens because I do have a relative strength, and I don't know, maybe that's too low of one. It could have been in an IPO screen. I do run. There's some others like accelerating margins because I'm not going to go through balance sheets of every single company. So, accelerating margins where it's really simple relative strength above 90. See how there's no rocket science in this? Current price above 20, trades over 200,000 shares. And then this is the part where I don't have the resources to dig through every balance sheet, but it's one of the options on Market Surge. After tax acceleration, basically companies that have shown after tax profit margin quarter over quarter for 3 years. So this is profit margin acceleration. Maybe it showed up in that one. That's something where I don't have the resources or the time to dig through that, but the database does it for you and it narrows it down to some of those names. So maybe that's where that showed up there, or it could have shown up on my recent IPO screen, which is another one I run as well. So that's probably where, and it's a great question and a fair question, but it showed up on one of those screens as well. Someone's saying they're looking to get into GEV, but it's hard to find an entry point that will let you manage risk. Very fair point. So what would you look for an entry point? I would wait for a pullback to the 21-day. I don't want to say it's never going to do that. If it doesn't, it's okay. This is what I mean by if people are looking to get into a stock and it doesn't provide a great entry point, you either pass or you wait patiently for a pullback or some sort of consolidation. If it doesn't, don't have FOMO. There's over 10,000 stocks. There's plenty of great ideas, especially in a good market. So this is where there are some stocks I want to get into and I've missed them. I don't care. I used to care, but I'm trying to impress upon you and let you know that if you're going to stress out and you miss this, and Susie on social media owns this, and some other douchebag owns it, and you stop that. Stop all of that. Comparison is the thief of joy. Stop worrying about what everyone else is doing. Sorry for the mini rant. Focus on getting better. And the way I got better is stop giving a shit about what everyone else is doing or what you think they're doing on social media and focus on getting better. And for me, I don't have FOMO anymore. There are literally stocks I give to my educational members that I don't enter for one reason or another, and they take off. I don't care. If they're making money off of it, God bless, that's great. My point is, you have to, what's that word? Accept that you can't own everything. You can't be in everything. You can't kiss all the girls or boys or whatever you're into. You can't be in everything. You just have to accept that. And if you miss something, just wait. And if it goes without you, because the last thing I want you to do is buy something extended, and then when it pulls back to normal support, get stopped out, and you get stopped out at a place where you should be buying, if that makes sense. Sorry for the mini rant. I'm just a fan of people improving their confidence and getting better at this. Somebody said they love the rants. There's a lot of questions here. Could you talk about power trends? Could you explain this and whether we'll see one soon? I would go to YouTube and YouTube Mike Webster Power Trends. He'll explain it way better than I can, how it's developed, how he developed that name. I just call it that 2 to 3 times a year the market's healthy. Um, and they happen to be power trends, but I'd rather just type in Mike Webster Power Trends. He has a couple videos. He'll explain it way better than I do. And for the sake of time, it's a lot easier to just direct you to that resource. Excuse me. Let me grab some water here. Give me 1 second. When you see a stock that's set up, do you want to see your holdings and your top watch list and the market moving the same direction on the day you enter? I'm not sure if I understand what you mean there, but ideally, if I see a stock that's set up, I would like the market not to be extended. I would like if it all correlates where it's, yeah, like the stocks are moving, if that's what you mean, like you're making money in your existing positions and you see another setup and the market's not too extended, the stock's not too extended. If they all correlate, yes, that would be ideal if that it helps answer the question. If that doesn't help, you can rephrase it. Joe, I'm a federal worker and the majority of my investments are in TSP, a thrift savings plan. Mostly invested in small and large cap ETFs. Does market surge work for helping being in and out of the market? Market surge for me, I like it because I can pull up a stock and it gives me everything I want on one page for the most part. A very simple way of getting everything on one page. But if you're mostly in ETFs, I mean, I'm not going to, I love the product and I use it. I'm not going to say you don't need it. I'm just saying you could use any charting platform as far as for being in and out of the markets, kind of like 50-day, 200 days on any free charting platform. Your brokerage account offers free ones. There's free stock charts. There's, all sorts of stuff. I like market search for individual stocks, but just being honest and fair, if you're mostly invested in ETFs because of the plan you have at work, you can use like free charting stuff. I think it's more helpful. It's definitely helpful for market analysis. For me, the bang for my buck is from individual stocks. So if you're not trading individual stocks, it might be overkill. Does the float size ever a criteria or deterrent for entering or not entering a stock? That's a great question. I'm trying to think of an example of, I think it was National Grocers, NVGC, or National Grocers, let me see, type it in. Grocers, what's the symbol there? Maybe it's something like that. Give me a second because that's an example of NGVC, something like that. There it is, Natural Grocers. There we go. That's an example of as it was building a base here and we had the follow through days in April. I mentioned it to members. I said I'm not going to enter it. It was on a different screen of mine because, again, I'm not Fidelity Magellan Fund. I'm not managing $100 billion where it's not liquid enough for me, but it's still, if it trades under 200,000 shares, this is an example where I said, look, I'm not going to buy it. For members, after the follow through days, it showed great relative strength. It was in the mid 40s. I said it provided a decent entry point. You're still up from it, after, and it shot up like crazy over the earnings. My point is that's an example of that's an example of one where the float or the average, volume, not necessarily the float, the average volume deterred me from getting into it because it was too thin for me. But I told educational members, if you want to get into 100, 300, 500, even 1,000 shares, that should be fine. If I was going to buy, again, I don't know, let's just say 20 or 30,000 shares, sure, it's liquid getting in, but if I have to stop myself out, I could get slammed in the name. So that's an example of if it's too low of a float, I might pass. But for an individual trader, you might be nimble enough and be able to trade something like that. But for the most part, I want to have more of my portfolio concentrated in the institutionally supported names. And then if I'm going to speculate with a smaller float name, it's just with a smaller portion of the portfolio. I'm all about okay with speculating. Just do it with a smaller portion of your portfolio. Um, I'm trying to see. There's some other questions that are a little bit more specific investment advice. I'll stick around for about 5 or 10 more minutes if you have any other questions. Just again, a lot of what I do here. If you enjoy the content, just if I can give a second to go back to this, the promo code take 100 off. I'm very grateful for the feedback I get. I'm confident you're going to learn a lot from the product. And again, I haven't raised every single product I've seen, almost every one that I've seen. Actually, every one that I have seen. There might be others I haven't seen. The prices have gone up. I started this in March of 2020 during COVID, and I've not raised my prices. And I was going to do it in March, but during the correction, I told my members I'm going to wait till later in the year. So it's the God's honest truth. The price is going up in September from $4.95 to $5.95 a quarter. So this is the last time you can get it at the $3.95 price, and you get an extra month. So I'm trying to be generous because there's opportunities now and things are getting better. And I think things are going to do well with corrections along the way. I think there's great opportunities still in AI and energy, some retail names, some other software names, and so forth. Basically, companies that are growing. I think there's great opportunities, and I'm confident that not only can help you with your own market analysis, but at the end of the day, yes, you want to keep people on the right side of the market. You want to help them with their confidence. You want to help them with everything. At the end of the day, we all just want to make money. I get it. So I feel like there's opportunities to hopefully make some people some money as well. So that's the discount code through the end of the month, and you get an extra month for free. And then the prices are going up in September. And as I said, you're going to get access to the seminars and the weekly videos, midweek videos, where they're about 20 to 30 minutes, where I take about 5 or 10 minutes to analyze the markets, see where we're at in the markets, and then go through some of the sector work. Sometimes go through, 10 or 20 stock names, sometimes 40 or 50 stock names, just to go through and take a look at some of the names that are acting well. So it's pretty straightforward to help guide people in the markets. Can you speak about when the 2 or 3 seasonal periods happen? No, just to go back to market surge, give me a second here. I want to clarify that. That's a great question. Market surge, here it is. There we go. Sorry, this is live, doing my best to keep up. My philosophy is the market's healthy 2 to 3 times a year, and I try to do my best to do my work and identify those healthy times and expose capital during those times. It's not, and if I misspoke, I want to be clear on this. It's not 2 or 3 seasonal periods. If it coincides with seasonality, that's great. Where, October through April tend to be strong. November, December, April are 3 of the strongest months. And August, September are 2 of the weaker months. But if things are set up and we're in a power trend, that overrides the seasonality. So sometimes those 2 to 3 healthy times overlap with the seasonal strength, but that's irrelevant. That's more of just looking for those 2 to 3 times a year, but it's not seasonal periods. It's just putting in the work when you get follow through days and so forth. I'm trying to think of an example of coming out of the correction. This was, let me go back to 2024 and go back to the end of 24. Was it 24 or 23? 23, maybe it was. Yeah, this is an example of, we came out in May of 2023 when NVIDIA had the first huge, what do you want to call it? Explosive earnings, when it gapped up huge around that time. You can even go back and look at NVIDIA. This was that big, huge gap up when it just shocked the world with that amazing number. That's when I feel the bull market really got started, was May of 2023. And I said that, and this was a great power trend. about 6 to 12 weeks or so, where it held the 21-day, that's when you can plow into the market, get aggressive, and really take advantage of a strong power trend. And then I literally put on my blog on July, whatever it was, maybe I even tweeted it out, said, look, I'm going to take some profits because we were extended and heading into the seasonally weak period of August and September. And that's what happened. And then we retested the 21 day and then had another Zweig breath thrust and 3 follow through days. This is November of 2023. And that's when I got more involved into the markets. And then we had a really nice power trend into the year end. So that's what I mean by those 2 to 3 times a year to really take advantage of those healthy times. And when I reset to today, I want to stress another point. That doesn't mean you get the dead low and the dead high. I'm trying to get this. I'm trying to get the meat or the bulk of the move. I don't claim to get the dead low or the dead high. And if you do, it's lucky. And that's not what I'm claiming or saying that that's what I'm trying to do. I'm just trying to say after a low is made and a follow through day or some sort of breath thrust come in, signs of what? The institution's coming back in and the power trend starts. That's the period where they say you make 80% of your money during 20% of the year. So that's what I'm trying to identify. Somebody's saying thanks for a great webinar. And thoughts on Toast and Dutch Brothers. I don't follow Toast that well. I know it's restaurant, processing equipment technology for restaurant sectors. Broke out there, made a nice run. It's been consolidating well there. I don't follow it too much. Looks like slow and steady growth. But again, I don't BS. If it's a company I don't follow because I can't follow everything, I just pass and say I don't have a strong opinion. Dutch Brothers, I do own, full disclosure. I think they're growing from 1,000 to 2,200 locations because it's mostly based on the West Coast and it's expanding, continuing to expand. So I like it. It's a little bit volatile, but I do like it longer term. Just my opinion. It's not investment advice, but I like to be transparent that I do own it. Somebody asked me about the power trend. Go check out Mike Webster's thing. It's so much easier based on that. Joe, how do you find leaders? I'm always late to that party. After I get the follow through days, that's when I'm paying attention to relative strength. When you get the follow through days, to pay attention to some of the stocks, and I identified some of these 4 members. I'm not going to go through all of them because just for the sake of there's some content I have to save for paying members, and I mean that to be sincere. But after the follow through days, I'm paying attention to the stocks that are acting well, that are emerging, that relative strength. When the market did this, the stocks did this. They just held up near their highs. So those are the ones that I try to identify and help members gravitate towards through focus lists and some of the leader lists that I go through. So hopefully that helps. Going back again, I really appreciate so many awesome questions. It's been over an hour and a half. So I appreciate the people who have stuck around. Thanks for putting up with me and listening and all the amazing, engaging questions. If some of them I couldn't answer because they're a little bit more, investment advice, I just have to be careful not to answer them. So I'm not going to apologize. I just couldn't answer certain questions. Thank you for your understanding. But if you're looking for more content, again, it's the last time I'm offering a discounted price as it's going up in September. Take 100 off. I'm confident you're going to learn a lot. Even if you don't sign up and you got a lot out of this, I'm grateful for that too. Like I said, if you learn one thing from a lecture or a webinar or a talk, I'm grateful for that too, because that's basically, as I get older and I'm learning more and more and trying to practice more and more, gratitude is the attitude. The more you're grateful for, the more God will give you to be grateful for. So I try to be grateful, and I'm grateful for all the awesome questions. You have one assignment this long weekend. Get out of your house. Do something to help your mental and physical well-being. Go for a walk. Go for anything. Read a book. I know we're passionate about the markets and we love the charts and all that stuff, but do something to help your physical and mental well-being. That's your only assignment Tell someone you love them. Call a friend you haven't talked to in a while. Do something to help you spiritually, to help with your gratitude, to help with your physical health, which will help build your mental health as well. That's your only assignment. If you can do that, that would be awesome. You don't have to. You can stay in your house and stare at Ethereum on a 1 minute chart and shoot heroin into your veins. You can do whatever you want. I really don't care. I'm joking. I just try to encourage people to do something to help their physical and mental health. And it's a long weekend. Hopefully it's decent weather wherever you are in the world. Get out of your house, go for a walk, smell some fresh air, get some vitamin D from the sun. And that's your only assignment. And your other assignments to sign up for my educational product. I'm kidding. If you want to, the promo code is there until the end of the month. I'm getting some great feedback. Some people saying thank you. I thank you for sticking around, for hanging out with me. I hope hopefully you learned something from it. And good luck with all your trading. Enjoy your long weekend. And hopefully we'll do another one of these soon again. Thank you so much.